Happy New Year. We hope that you all enjoyed a great holiday week and were able to spend some quality time with your families. This is the first monthly market perspective call for 2023, so welcome. My name is Tom Steinley, and I'm the Director of Business Development at Lear. I'm joined today by our Head of Research and Co-Portfolio Manager, Jim Warner, to whom I will turn the call over momentarily. For the benefit of a few first-time attendees that I've noticed have logged onto the call, I'd like to spend a minute just highlighting how our approach to portfolio management is unique and we believe a better way to invest. Unlike most of the investment world, we don't believe in traditional static style box portfolios. We believe that the risk of the portfolio should change based on what's going on in the world. We manage a concentrated portfolio of 30 securities representing our very best ideas. For one security to be added to the portfolio, another has to be removed. The security selection process is based on our proprietary research, and each portfolio is populated based on identifying secular global macro themes like commodities as a hedge for inflation, scarcity of resources, rising interest rates, and clean energy. Lastly, communication is the key. Communication that goes beyond just market metrics. We provide investors information that helps them understand what changing market and economic conditions means to their portfolio. We're very clear about what's in the portfolio and why, and I think we do this better than any firm I've ever seen. That's what these monthly calls are about, and nobody delivers this content better than Jim. So with that, Jim, I'll turn it over to you.
Thanks, Tom. Appreciate that. And thank you all for joining us, and Happy New Year. So let's jump right in. I'm going to share my screen. We'll get right into this month's monthly strategy update. So the title of this outlook is the 2023 outlook. And the message that we want to get across, if there's one thing that you should take away from this whole presentation is this is going to be a year to be patient, particularly in the first half. So with that, let me jump right in. Let me do a quick review of what happened in 2022. If you recall, if you've been listening to these calls for a year now, last year we issued our 2022 outlook, and I used this symbol of fasten your seatbelt symbol to articulate what our views were on the upcoming year. And essentially, we were quite concerned about rising inflation, driving up interest rates, the impact that would have to bond prices, particularly those with long duration, because they're much more sensitive to interest rate changes, and also to growth stocks that we believe were trading at bubble valuations. We also expected, on top of all this, just a general worsening in the economic environment. We called this the decelerating to normal. And if the other analogy we used was, 2021, we were essentially an airplane flying. The economy was an airplane flying at 70,000 feet. 2022 was going to be about descending down to some more normal level. And, the question is, of course, will we go too far and fall into a recession, or would there be some sort of a soft landing? We weren't really sure a year ago. We have some more precise thoughts that we've enumerated over the past few months, and I'll go into those in a bit. But taken together, we saw this just generally as a worsening market environment and would increase the likelihood of higher volatility. And so we advocated a much more conservative market positioning and avoidance of fixed income duration, underweighting growth, overweighting commodity exposure, as Tom said, as a hedge to inflation. And that's how we proceeded. We also used this framework for last year. And really what this is essentially saying is that the most important drivers of what was going to happen last year was inflation and employment. And both came in better than expected, or higher than expected, I should say. Inflation came in higher and employment was better than expected. And then that really would sort of move its way into what pace at which the Fed needed to tighten, because tightening was obviously on the horizon. But it turned out to be much faster pace, and interest rates ended up being much higher than I think we or any other market participant expected last year. Surprisingly, consumer spending kept rising last year, which we actually believe that there'd be a bit of a deceleration after the stimulus fueled spending of 2021. We figured that that would ebb, and to some extent it has, but it's really been about a mix shift. And I'll talk a bit about what we see in that sort of two-speed economy in a minute. And then ultimately, what that's led to is essentially weaker corporate earnings. And this is essentially the framework that we used to help us think about where we wanted to be positioned from an asset perspective, but also from the type of bond that we wanted to own and the type of stock that we wanted to own. Obviously, the culprits of this past year's volatility and declines were inflation and the resultant increase in interest rates. And I think the persistence of high inflation certainly created the higher than expected rise in interest rates, and hence the substantial volatility in both the stock and bond markets. And what made last year so difficult and so frustrating for many, particularly conservative investors, is that your bonds didn't work, and obviously your stocks didn't work, and the driver of this was just this radical change in inflation rate expectations. If you look at this graph, in the little small green bar here that I'm circling with my cursor, 1 year ago today, the market expected that the Fed funds overnight rate would be 0.9% in February of 2023. Move forward a year to today, the current expectation is that the Fed funds interest rate next month will be 4.7%. So that is a radical change in expectations that had to get digested last year. And clearly this was driven by the surge in inflation, the Fed trying to play catch up, and obviously the market is now at a point where with the current target rate at 4.5%, the market is expecting that the Fed will will top out at 5%. I think one other interesting point to be made on this chart is that you can see that it starts to taper off as we get further into 2023 and into 2024. There's even an expectation of a couple rate cuts. Now, this is going to be really, we're going to get into this more, but basically this is really the key item to focus on in 2023 is what happens to this curve? What happens to interest rates? Does the Fed pause, which is what essentially is inferred by this chart? And do they even pivot to loosening up interest rates? And clearly that would happen in the case of a lot of economic stress. So, to put this in a more visual perspective, 2022 was a very, very rare year. Going back to 1977, when the U.S. Aggregate Bond Index, really the key measure for bonds, this is the first time that both that bond index and the S&P were down for the year. The S&P 500 was down 18% last year. The U.S. Aggregate Bond Index was down 13%. And this is really, really unusual. You can see from the graph that it just rarely happens. Typically, bonds are hedged for stocks, right? That's what we've all known. This is what the evidence would show, that in years when the blue area, that's the stocks, are down, the green area is up. And so that's why people have bonds in their portfolios. It didn't work this past year, and on a very large scale, obviously being down 13%. So let's put some historical context around this. The surging inflation and obviously record interest rate increases created the worst bond rout in 45 years. And so if you look at this first index, this first column here, we went back to, as I said, 1977 for the bond index. Since then, in those 46 years, there's only been 5 years that bonds were down. That's only 11% of the time. And the average down year was 4.1%. Last year's down 13% was a record by several standard deviations. Just to put what happened to the bond market into perspective. The bond market also put together its very first back-to-back losses since 1977. Recall that in 2021, the bond market was down a little over 1%. If we turn to the equity market, it was also, fairly unusual. Um, the S&P's 18% decline is the fourth worst in the last 50 years. We were able to go back a little further to make this analysis back to 1972. And there's only been 2 years where you had back-to-back declines, annual declines in the S&P 500. Those were in 1973, 74, right? You had the oil embargo and very high inflation. And in 2000, 2002, where you had, the dot-com bubble explode and essentially it dragged out, and there was a shallow recession. And by the way, I would add, as you'll come to realize that we're still fairly cautious on the equity market because we've got actually both of the components that created those two sequential back-to-back declines. We still have persistently high inflation, although it is trending in the right direction, which is down. There's somewhat of an energy situation going on, which is part of the issue back then. But we're living with the fallout from sort of the tech bubble and growth bubble correcting. So, it's entirely likely that we could have another down year for the S&P. And then obviously we all know about the carnage that happened in the NASDAQ. The NASDAQ declined 33%. It's the fourth worst in its last 50 years. And I think what's important also to note here is that the NASDAQ finishes down 28% of the time. And the average down year is 20%. So the worst year was down 40% in 2008. So, it shouldn't be entirely surprising that you're going to see down markets from time to time in the NASDAQ. So as we know, it was a very tough year. Interest rate sensitivity was the key to 2022. But the market is now shifting its focus towards economic growth, right? You hear about it if you turn on CNBC about the question of whether we have a recession or not coming and just how bad might it be. If we look at briefly at the global equity markets, you can see that the global positioning did ultimately matter. The markets that had bubbles underperformed, and those that did not sort of held in there okay. What I think is kind of most surprising is how you can see the Euro Stocks Index was down 8.7%, and the FTSE was actually up 4%. Those are on local terms, but you can see that those didn't have bubbles to begin with, so they didn't have as much to correct. But it is pretty remarkable in light of the energy crisis and downturn that Europe is facing, that obviously was exacerbated by the Ukraine invasion. In fixed income, I think this is probably one of the wildest slides that we'll see probably at any year-end presentation. But just to see the aggregate bond index down 13%, U.S. investment grade down almost 16%. It just tells you just how much carnage there was in the bond market. If you go way out in duration to the long end of the Treasury curve, down 31%. These are just remarkably bad performances. And going in, as we mentioned to people, there was a possibility of this because when you have low interest rates, as we did a year ago, that creates an enormous amount of convexity risk, which is the sensitivity to changes in interest rates. And so that's what's creating this enormous, this enormous decline in performance. But here's the good news. The good news is that a lot of these fixed income products are now back to places where they have really pretty attractive yields. And so we'll talk a little bit more about why we're really in favor of owning fixed income this year. And then just to touch on commodities, it was a wild ride. Generally, commodities all finished up. There was a massive spike in the energy complex when Russia invaded Ukraine. That has essentially rolled over. Industrial metals kind of struggled most of the year, but have now started to pick up as China's COVID zero policy has really been pushed aside. And people look forward now to China reopening and kind of jump-starting their economy. And then gold, gold had been a bit of a frustrating position for most of the year until the fourth quarter, where generally gold serves as a great inflation hedge, but it didn't really work. It outperformed the index, but it didn't really work until the fourth quarter. We still think that that's a pretty attractive place to be. I think that you had to pick a chart of the year, though. It would be gasoline prices, and this is the daily national average gasoline prices in the U.S. and just the wild trip that we took. Now, going forward, it's going to be interesting because there's been really no increased. There's really no sort of short to medium term expectation for increases in production. Meanwhile, you're going to have China turning on, and you're also not going to have the strategic petroleum reserve sales that we've experienced over the last number of months. So, I think that this is going to continue to be an interesting chart to watch going forward. But, I think one of the things that we've seen, particularly as it relates to the consumer, is consumer was really pinched during the summer months when gasoline prices were high. And I think, the sort of alleviation of that pain at the pump has been very supportive of consumer spending. So let's just quickly touch on some core economic data, and then we'll jump into the 2023 outlook. We've been saying, and I think it's contrary to most of the market strategists out there, that you really need to look at this economy and separate it into two different areas. One is the goods part of the economy. This is the part of the economy that did fantastic during the pandemic. It is now, we believe, in recession. And then there's the services part of the economy. And we think that that's actually still growing quite well and has a chance to really hang in there. Taking the two together, when asked, "Oh, do you think we're going to go into recession?" My answer has been for the last number of months, well, part of our economy is already in recession, and part of our economy is not. And so, to the extent that that is merely a function of demand shifting from the goods area of the economy to the services area of the economy, then all else equal, there should be a relatively soft landing. That's what we're watching very closely to see is whether or not that is an accurate hypothesis. But as you can see from the ISM PMIs, these are diffusion indexes. So anytime you see a number below 50, it means there's contraction in that part of the economy. So in the manufacturing part of the economy, we've been contracting now for 2 months. And obviously the trend line is down and to the right. If you look to the services PMI, the services part of the economy, things are hanging in there and growing quite nicely. So they're not growing at the crazy levels they were in 2021, reflected in, this 68.4 number, but this mid 50s number is a very solid, nice growth trajectory for services. And so we've yet to see any weakness really seep into that part of the economy. And part of the reason is because the consumer is still chugging along. Despite all the inflationary pressures that consumers have felt this year, they've been extremely resilient. And, much to our surprise, honestly, we thought spending would decline, but it has kept climbing. You can see that personal consumption expenditures on the right, $17.8 trillion. I mean, nominally speaking, it continues to set records. And you can see that consumer sentiment has even kind of picked back up from the summer lows. A lot of these lows were driven by the high gas prices I just referenced. Not a super optimistic consumer, but certainly not a super pessimistic one either. And, I think what's the push and pull here that is going to be interesting to watch during 2023 is, high interest rates are clearly impacting big ticket sales, whether it's cars or houses. But that's going to continue into 2023. That will be a very weak part of the economy. But there is going to be likely lower inflation, and that could actually help not only support spending, but even help support consumer discretionary spending. Because much of what's happened over the last year is that folks have not only shifted from buying pandemic goods to services, but they've also had to shift from buying, nice to have products and services to have products and services. So we're watching that shift in consumption pretty closely. But what's obviously sustaining this consumer spending at these high levels is a strong labor market. And, as we identified last month, there's a couple of areas where we're seeing weakness, like in retail and in the distribution networks. And also we expect to see growing levels of layoffs within the tech sector. Salesforce, for example, laid off 10,000 workers this morning. We think more and more of that will happen. And so we're watching this payrolls very closely, and we'll have a really important print on Friday that'll be interesting to watch. Not just for the unemployment rate, but also for which is still at near record lows at 3.7%, but also for the wages paid, or the growth in wages, which has been elevated. So historically, wage growth annually is about 2 to 3%, and we've been running at levels in the 5.5% range. And so our intuition is that that's going to soften as the economy generally softens this year. And we will be watching that closely, partly because the Fed will also be watching that closely. And so, as we've talked about for a number of months now, this goods recession, we think is actually starting to accelerate. The chart on the left basically is a survey that the ISM does with purchasers in the supply chain, and they ask them, like, how do you view your inventories? Are they too low? Are they just right? Are they too high? And when you get to about 48, 50% of just right, it really indicates that there's no restocking trade that's going to be there to support growth, inventory growth, which obviously feeds directly into GDP. So we're at a point now where we can't rely on growth through inventories. And what that's also doing is putting downward pressure in the supply chain on prices, and partly what's also contributing to that is lower commodity prices. But as you can see, again, this is a diffusion index. So at 39, there's a lot of contraction going on, or deflation occurring within the supply chain. Again, that's good for the overall picture in terms of the overall inflation picture and continuing that downward trend. But it certainly does indicate that things are really slowing down in the supply chain. The other thing that we've mentioned is that retailers are still holding too much inventory. There was a big over ordering that happened in the first half. I just sort of took a snippet here in the first half of the end of last year and the first half of the year, and there was this big surge. You can sort of see the growth rates accelerated up to 20%. Now, going into the holiday periods, you've seen a significant amount of discounting to clear that inventory, and certain retailers are doing this better than others. But if you're one that ordered too much of the wrong inventory, you're having some serious margin problems at this point. So, those are types of places that we are avoiding at this point. I think one thing that we have to start thinking about as portfolio managers is, will the EU emerge from recession? And if they are, then is that an interesting place to start looking for value? And as you can, the reason why I raised that question, which sounds, it sounds a little crazy, in that given the stress that in the energy crisis that they're facing, due largely to Russia's invasion of Ukraine, you're seeing a significant contraction in GDP in the EU, but yet in the manufacturing sector, you're starting to see a little bit of a pickup, and you're also starting to see a little bit of a pickup in services. So it may very well be that the EU economy is starting to turn the corner. So keeping an eye on that. We really don't have much exposure in any of our strategies to Europe at this point, but it's always interesting to see, because remember the market is going to discount in a recession usually before it even happens, and the market tends to bottom before the economy has really made its turn. I think the other really fascinating area that we're spending a lot of time on is, will East Asia or even Southeast Asia return to growth? If you recall, like Korea in particular, and Japan to a lesser extent, is really exposed to the semiconductor industry, and we've basically just gone from a chip shortage to a chip glut, and that those economies are working through that. But China's reopening is very interesting, and if you think about where in the world are you going to see accelerating economic growth, well, it's going to be probably China and those regional countries that are going to get dragged up with that. And so we're watching that very closely about China's reopening. So Korea to us and Japan are really interesting areas. We have a little bit of exposure to Japan right now. So let's finally get to our 2023 market outlook and strategy. And let me start with sort of our worldview economic base cases. And for a U.S. perspective, we still believe there's a goods recession, on an ongoing goods recession, and we think that continues probably for another few quarters as consumer spending also, as they're trying to clear inventory and doing it as consumer spending faces increasing headwinds, particularly higher interest rates and potentially higher unemployment. And to that end, we expect increasing layoffs in the goods sector and the tech sector specifically, and that could drive the unemployment rate up to 5 or 6%. The services too, although we expect growth there, we expect that growth to decelerate. Some of the tailwinds of the reopening trade and people going back to eating in restaurants and traveling, some of that excessive growth is going to wear off a bit. But that said, with inflation fading during the year, that could actually help the consumer. We think that political gridlock with the Republicans taking the House may reduce the government's role in the markets. One of the other challenging factors over the last couple of years has been the excessive amount of whether it's fiscal stimulus or various infrastructure bills, the Inflation Reduction Act. There's trillions and trillions of dollars that have been injected or will be injected into the economy. But some level of the noise out of Washington quieting down, I think, would be productive. So as we think about the biggest downside risk, it hinges on the Fed. So if the Fed over tightens, whether that's because there's higher inflation than we expected, or they just make a policy mistake, that actually could create a problem for the markets, and also a problem for the economy, and potentially broaden out this goods recession into the services sectors as well. The biggest upside risk, because we can't always be pessimistic, is that the Fed cuts interest rates. They see that the trajectory of inflation is going in the right way. Perhaps unemployment gets to 6%, which they find unpalatable, because remember, they have a mandate for full employment, as well as containing control over prices. And so, that could actually be a very positive scenario for risk assets. The European outlook, it's gloomy. But, as we just saw in the European PMIs, it's always, darkest before dawn. And, it's possible that we could see a resurgence in Europe. As strange as that may sound at this moment, as we look out a year or so, that could actually be the case. Obviously, Ukraine is a big wild card, and Russia is a wild card, and how that situation gets resolved is frankly unknowable. But any sort of ceasefire would obviously lift sentiment tremendously. So we'll see what goes on there. Again, I go for the biggest downside risk. I go back to their own central bank, the European Central Bank, and if they are in a process right now of trying to tackle very high inflation, and they're tightening rates, and in the face of an energy crisis and destruction of demand. And so, I think it's really important that they don't overdo it. That would be very bad for the markets and for the economy. And conversely, if they keep interest rates low because they see inflation going in the right direction, and perhaps even add some fiscal stimulus, and perhaps if they've all the various different things that they've tried to avert, or at least contain their energy crisis, that could actually create some significant upside risk. If we look briefly at Asia, I mentioned that we're really focused on the not investing directly in China and their reopening, but in those countries around them and the companies in those countries that will benefit from that. I think it would be prudent, though, to recognize that just like in this country, we had whenever we got a surge in cases or a surge in hospitalizations, it created sort of this sort of lumpy recovery. And so I would expect that the economic recovery that China experiences is going to likely be lumpy too. And I think emerging markets are starting to look very interesting. And I think tied to the Chinese reopening and recovery, but also the weakening dollar, which we would expect, um, is certainly helpful. So, we're spending a lot of time looking at those opportunities. So I think, when you really stop and ask yourself, well, what are we really, it seems like a lot of your what you're looking into is the Fed's reaction, and I think that's partly true. So what is the Fed going to do? And I think the question is, do they pause or do they pivot and start cutting rates? And we've been told by them that they're looking for a sustained evidence of disinflation, and we have a couple of months of that, but probably maybe enough to pause the hikes, but certainly not enough to start to see cuts. Um, a softening labor market. We've seen the unemployment rate tick up just a little bit, but the labor market is still very, very strong. I think a more higher frequency data point that we're looking at is continuing claims, and you can see from this chart below that the blue area is a 4-week rolling average of continuing claims, and it is just now getting to the average level of claims during 2019. Right? Recall 2019, we had roughly 3.5% unemployment, generally in the area that we are today. And we've been trending well below that for quite some time. So that's certainly something that the Fed wants to see, is a normalization or softening of the labor market. And we're still in very early innings of that. And they did indicate that they're looking for other economic signs of softness. And one of those signs is clearly in the housing market and in the used car price market. Both areas experienced terrific bubbles during the pandemic. And with the rise in interest rates, these sectors have really gotten hit very hard. You can see on the graph on the left, these pending home sales have just really fallen off a cliff as the blue line, which is mortgage rates, have climbed. And similarly, you're starting to see a rolling over of the used car prices. So, that's another factor that the Fed will take into consideration. So, as we've discussed in previous calls, what is this path to a new market cycle, or out the other side of looking out past the other side of a recession? And we've used this framework, and it's so far worked fairly well. Is first we were looking for inflation to decline. We've gotten that. Then we were looking for interest rates to stabilize. We've gotten that for the most part. That has essentially emboldened us on our bull case for fixed income, particularly high quality fixed income, and even allowed us to sort of dabble a bit in some of the growthy tech names that have been hit very, very hard. But ultimately, what we need for stocks to really work is our earnings estimates to stabilize. And depending on the sector, this could take the next 3, 6, or even longer, 3 to 6 months or longer, for the market to get comfortable with where their estimates are. Once the market believes that the estimates are low enough, the market will then look past that to the next year to see what the true earnings power can be for a company in a normal environment. And so we're sort of sitting here, which makes us a little, not very sanguine on the market. And another thing that's kind of bothers us right now about the equity market, and why we may not have seen the lows yet, is that we haven't seen estimates come down enough. We talked a lot about this last month, but in the month that we've just wrapped up, you've had a lot of analysts come out with their 2023 outlooks, and it's been an opportunity for them to readjust their earnings expectations for 2023. And it's hard to see on this graph on the left, but basically these earnings estimates for the S&P are only down 6.5% from their highs, and those estimates still reflect 5.7% growth over 2022. And it seems to me that would be rather aggressive if we were going to go into a recession. And so, to the extent that the goods recession that we see spills over into the services side of the world, there's still a lot of estimate correction that needs to occur, which could drive the market down. In addition, we're doing this at a time where the market is currently trading at 17 and a half times those EPS numbers. And so, that too could, you can see a contraction in the multiple. So we're not entirely convinced that the S&P as a broader index is at its lowest just yet. So how does this dovetail into then our market strategy? It means that we need to remain defensively positioned to protect capital. Now, I know that's boring, and that's partly the reason why we've entitled this presentation "Be Patient." But basically, we expect the economic growth risks to increase as we go through the year, particularly in the first half. As I just identified, we don't believe that earnings estimates are low enough market wide, and so we're not willing to step in and take undue risk in the equity market at this point. However, and part of the reason for this is that we now have a really good alternative. Fixed income, particularly high quality fixed income like mortgage-backed securities and treasuries and investment grade bonds, now offer a really attractive risk-adjusted return opportunity and have basically become the hedge for stocks that they've been over the last 50 years. And so this gives us a genuine alternative to take much less risk, earn a good returns. In some cases, these are equity-like returns, and wait it out. And so, a lot of the, convexity risk, which is, the risk to changes in the interest rate, a lot of that's out of these bonds now. Where there's still some risk in the fixed income world, we believe is really in two places. There's floating rate risk, which are bank loans, generally highly levered bank loans, and the credit risk that's embedded in high yield. We still think that you have to be very selective when you enter that market. So, and from a duration perspective, well, a year ago we said don't have any duration, bring in your duration on the fixed income. Now we're a little bit more indifferent. So we've taken more of a barbell approach where you can lock in some great short-term, rates like 4+% treasuries, and just hold a maturity. But we don't want to tie up capital that way. So you can also go out the curve, and which offers some really great yields, but also some mark-to-market upside as those markets recover. So, and then shifting to equities, there's certainly a growing number of stocks that we are interested in, but we're not convinced are just an outright buy. The ones that we do have in the portfolio, have what we think are the three requirements you need: defensible earnings, attractive valuations, and strong secular trends. Tom mentioned a few at the beginning of this, but areas like the clean energy or the general decarbonization that's going on across a number of different industries, that is also backed by the Inflation Reduction Act and all the subsidies that are buried in that document. These are areas where we feel a lot more comfortable, but it's a very selected number that we feel great on. So just to sum up, I mean, we are short-term bearish on equities, but bullish on high-quality fixed income. And so I guess I'll just wrap up on this page, and then we can go to a Q&A. The key theme obviously is be patient. Take advantage of these great yields and bonds, and there's some equity-like returns out there. I talked about last month mortgage-backed securities, where not only had interest rates caused them to those prices to decline dramatically, but the spreads have blown out too. So there's some really attractive value there. And use these bonds as a hedge to your equity exposure. Again, economic uncertainty drives earnings uncertainty, so we're very careful about our equity exposure, and we think the first half could be tough. So we're selective on stocks. We ran through a couple of examples before. We can talk more about it offline or through Q&A. But effectively, what we're doing is keeping our powder dry and being ready to exploit opportunities as they come, whether it's international opportunities, try and take advantage of the Chinese recovery and the weaker dollar, or various other opportunities that will present themselves over the coming year. So I think with that, Tom, let me turn it back to you. Looks like we've got a number of questions in the you know, to answer, and I'm happy to do that.
You bet. Thanks, Jim. As always, great information. For everybody on the call, I neglected to remind you that we do have a Q&A box. Looks like we have several questions, so we'll get started. Here is, given the energy sector was up 66% in 2022, we see the portfolio holding several energy companies. Is this a continuing theme / opportunity you see throughout 2023? What would be the catalyst causing you to sell out of these positions?
Yeah, so we are, in the process of unwinding some of those positions. They have energy positions can turn very volatile very quickly, and we've certainly seen that. There's an unusual level of volatility in the markets, and a couple of these stocks have gotten caught up in it, and so those are what we're looking to address. There are other names in our energy exposure that really have nothing to do with the commodity prices themselves. For example, our exposure to exporting LNG that really has, or our exposure to MLPs. Those business models are not levered to commodity prices per se. So we certainly do like energy generally. We are, from a risk standpoint, not enjoying the volatility that we're experiencing in some of those names, and are going to, and we'll likely address that. But that being said, there is a structural supply and demand problem that is in a number of these energy markets. And so it's a place that we may revisit in the future.
Great. Thank you. With earnings at risk, why would PEs stay at 17.5 times?
Yeah, they won't. So, normally what happens is, we've shown a chart in the past where oftentimes the S&P, for example, will essentially, the PE will compress to about 14 times. And then there's a lag for when and that's usually when the EPS estimates are still near their peak and haven't been revised down. Once those estimates start to come down, then you start to see the PE start to expand. So as I pointed out in that chart, I'll go back to it. We've only seen estimates come down 6.5%, and we're still trading at 17.5 times. So you're making the argument that essentially I'm making for why it's entirely likely you're going to see the market go down further from here.
What is being reduced in the portfolio to take advantage of higher rates available in fixed income?
Well, generally we've been shifting out of equities and commodities and into fixed income. So I just answer that broadly.
Got it. What is the percentage of equities the portfolio is now holding, and how has that changed from the beginning of 2022?
Yeah, so we are at, we're basically around 45% equities today. It's probably going to remain somewhere in that range for the foreseeable future. And we entered the year with, probably roughly around that level. I'd have to go back and check, but essentially we've been pretty defensively positioned, now for a year.
So Jim, I hear from a lot of people that many experts think a recession is coming in 2023. What would have to happen for such a thing to come to fruition, and what is the likelihood of it happening? Or are we perhaps already in a recession? I think you mentioned there's two separate issues here. One is a goods recession, the other one is a service recession.
Yeah. Look, I think what's unusual about where we are today is, people talk about a recession. Well, the fact is that we have part of the economy that's already in a recession. And we're probably still, in the first half of a goods recession, and that will continue to play out. Again, it comes back to, does consumer spending and business spending roll over to the degree that the services side of the economy starts to roll over? And right now, we're really not seeing a whole lot of evidence of that. It is the case that inflation took a bite out of volumes being purchased. And so the inflation so while spending continued to go up, the amount of volumes that were being purchased was sort of flattish. So we're kind of in a bit of a sluggish economy as it is. It is, to really see a big, huge, massive recession takes some form of a crisis. And whether that crisis is financial, like in 2008, we don't see that happening. Or a housing crisis like in 2008, we don't see that happening. Or some sort of currency crisis, which we don't see happening, or a pandemic, which we don't see happening again. I think we're just going to have sort of this goods recession and just a general deceleration in the services economy. And I think if you're caught up in the notion of a recession, you're going to miss the opportunity, because the opportunity set right now is that there are a lot of individual businesses that are highly defensive, where recession or not, are just going to power through. And there are going to be those businesses that have really strong secular tailwinds that recession will have very little impact on. So, those are the areas that we prefer right now, and where we do have risk associated. But, obviously we think about every day what parts of the economy are weakening and what parts of the economy are strengthening, and we kind of prefer to be in the ones that are strengthening.
Okay. There are two more questions, Jim, if we could hang on for a minute. One of them is, will we be able to get the deck? And the answer is yes. This call is being recorded and will go through compliance. And once it's approved, it'll be sent out to everybody on the call. The deck itself, Jim, is that available to send, or just the recording?
We will send out the deck with the replay, the recording, probably in a day or two.
Okay, great. And then the last question is, can you comment on the positions in Vermilion Energy and Google?
Yeah, we're not going to comment on any individual positions on this call. Happy to take that question offline.
Yeah, that's a good idea.
It's also a compliance thing. It's not, it's not an unwillingness to comment on it. It's the lawyers tapping you on the shoulder sort of thing.
Right. So just know that the Jim and the members of the portfolio management team are open to having conversations about just that sort of question. So it's about 10 minutes to 1 here in the East, 10 minutes to 12 Central. And I think that just about does it. I want to thank everybody for taking the time to spend the last hour with us, and hopefully you'll join us in early February for the February market update. Have a great month, and Jim, thanks so much for your time and your research.
Thank you, and thanks to everyone who attended.